So our prospect for gold throughout the course of the year is that there are a lot of risks that make it very, very likely it's going to perform well. And we see that even if the world turns into a direction that makes it comfortable, easier to understand, softer in the landing, so to speak, because of the unique nature of gold, the allocation to gold is still worth it. You want the shock absorber in the portfolio, but you also want the wealth creation and the correlation diversification benefits you get from gold.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Without prompting, the majority of experts recently appearing on this channel have agreed that gold is looking well positioned to move higher in price, potentially substantially higher this year. And that's on top of gold's strong start to the year. It's up around 10% since early January and is currently not all that far from its all-time high. So it's time to take an intentionally close look at the gold market and its prospects. To provide that for us, we're fortunate to speak today with Joe Cavatony, the World Gold Council's market strategist for its American operations. Joe, thanks so much for joining us today.
It's great to be here, Adam, and I'm really excited about our discussion today.
Thanks. Well, me too. Look, gold, as I said, a lot of the experts that have come on this channel recently, not by any design of mine, but when asked, how are you allocating for the road you see ahead? The vast majority of them are giving gold a place in their portfolios. I do know we have a lot of viewers here too that have been following the precious metals market. So it's high time we just did a conversation just dedicated to the dynamics of what's going on in the gold market. And I'm so glad you agreed to come here and do that for us. Real quickly, before we get to gold, though, I'd just like to start this conversation with a question I tend to ask all my guests when they first come on the program. What's your current assessment of the global economy and financial markets?
Great question to start with. And I really have spent a lot of time remembering and staying fixated on what we referred to prior to COVID, even the moment of lockdown under COVID, to the wall of worry. And ironically, the risk factors that were playing out several years back, interestingly, continue to plague us on a global scale. The inflated prices of assets, whether those are equities, bonds around the globe, the risk of inflation, the overall geopolitical concerns and risks. Now, the factors that were being talked about in 2019 might have been slightly different in terms of the nuanced experiences and the specific instances we're talking to. But when I look at today, we still have these same factors at play. We've got the risk of headwind against gold and the economy looking at how are we going to be managing inflationary risks? How do you manage that? What becomes the next stage in that management of that financial cycle, the monetary policy? How does it play out? You've got ongoing tensions around the globe, and you ultimately have a lot of things that are weighing on people's feelings and creating a lot of concern, question, and fear. And so these things are all playing into what I think is a very challenging, very complex world where politics and monetary policy and financial risks are very difficult to break apart. And so I just see it as a very, very frightening time with a lot of risks and a lot of concerns around how am I going to preserve my wealth? How am I going to maintain the kind of cash flows I need to live? And ultimately, this is not a US phenomenon only. This is a phenomenon that's playing out in the Western world. It's playing out in different ways, potentially in emerging markets. But risk, questions around risk, uncertainty, these are all still with us and still very, very complicated to manage.
Yeah, that's a great point, Joe, which I probably should talk about more on this channel, which is we could have had a very detailed discussion, on this exact topic, touching upon the issues that you just talked about, the challenges you just talked about in 2019, right? Before anybody had ever heard the word COVID, right? Now, the pandemic kind of lobbed a couple of big grenades into that soup, right? And it did, it let the inflation genie out of the bottle, right? Fully. But, all the risks that you just talked about there, all the concerns you talked about there, they pre-existed 2020. We just have, we're just further down the timeline right now, and some of those things have been exacerbated by a lot of the unprecedented developments that have happened in the past 3 years. So, okay, I'm really interested to explore every one of those things with you. Second question, another big general jumping off question here, which is, what is your current assessment for the prospects for gold this year? I got a lot of individual questions, but just at a very high level, as you look out across the rest of 2023 here, how do you see gold situated?
It's a unique asset amongst commodities. It serves as a financial asset, and it has probably the most unique ways it's being consumed, the demand side for gold, amongst any of the different commodities in our that we often talk about, are real assets. So you've got a central banking consumption channel, you've got investment consumption channel, you've got technology, and you've got jewelry and consumers. So you've got this really unique asset. And what it really has is a characteristic that allows it to perform exceptionally well on the downside, which we know, but also perform really well because it has the right kind of diversification benefits on the upside. So our prospect for gold throughout the course of the year is that there are a lot of risks that make it very, very likely it's going to perform well. And we see that even if the world turns into a direction that makes it comfortable, easier to understand, softer in the landing, so to speak, because of the unique nature of gold, the allocation to gold is still worth it. You want the shock absorber in the portfolio, but you also want the wealth creation and the correlation diversification benefits you get from gold. So we like the way it's lined up for gold over the course of the remainder of the year. We will be in choppy waters, so the price will go up and down. But as you pointed out, we're looking close to about 11% year to date in terms of the return profile. That'll go up and down. But over the long term, our prospects are very strong for gold. And a portfolio allocation or an ownership of gold, however you want to express it, vital.
Okay, great. And we will get to sort of the mindset for putting together a portfolio allocation as we get further into this conversation. Really quickly, I'm realizing I introduced you as a CEO of the World Gold Council's American operation. We didn't really define what the World Gold Council is and what its mission is. So could you take a moment and do that for folks? And
Sure.
maybe if you could, just to try to quell any skeptics, people might think somebody from the World Gold Council, their number one job is just to have gold be the answer to every question. So combat that cynicism, if you will, too.
Sure, absolutely. And I think it's a very simple thing for us to discuss. So we have members that make up our organization. The world's largest gold mining companies, about 36 members, they make up the World Gold Council's ownership. And our objective, our goal, our mission is to educate, improve access, and ultimately adoption of gold around the globe. So we work on market structure issues. We work on data, research, and insights. We provide that information to people so that they can make an educated decision on how much gold, how to buy gold, etc. We work on just evolving the market overall so that it is trusted and actually transparent. And people feel very comfortable with understanding it as an asset class, understanding how it could fit into their lives, whether it's in the consumption way in the form of jewelry, or as a component of technology, or in the world of an investment. And then ultimately making that decision and feeling that they can trust the data, trust the information. And when they get to the point of purchasing and owning gold, consuming it, that they have everything they need to have so that they can make an educated and fair and reasonable assessment of the market to buy. And that's our goal. Improving access, improving education, and ultimately improving trust around the gold market.
All right, great. So one of the things that your organization does is it produces these reports quarterly of key trends going on in gold, and it's just filled with tons of data, tons of charts. I want to pull up a few here if we can talk about them. The first is the dynamics of gold demand. So gold, the main, I guess, parts of gold demand are, retail buying. You mentioned technology. There's investment demand out there as well. And you have some places around the world that historically, buy a lot more gold than other places around the world. So looking at this chart that's up here on the screen, this shows sort of, what we're currently seeing right now on a quarter by quarter basis and what's driving it here. Looking at your summary, it looks like central banks are buying more, so that's a plus. China consumer demand for gold is picking up. On the negative side, you're seeing a little bit less purchasing in ETFs and a little bit less purchasing per normal from India. And China and India tend to be two really big parts around the world that buy gold. So right now, it sort of seems like a little bit of a tug of war between some of these more positive ones and some that are cooling off a little bit. What color do you have to add around that?
Yeah, I think the first quarter of 2023 is actually really kind of a cool quarter to take a look at, because it tells you a lot about how gold gets understood and bought. Like you've highlighted it. Central banks, and this has been a trend that we've been seeing for about 13 years, have been net buyers across the board in the gold space. They've been increasing that level of consumption across the board. They have been diversifying their reserve currency portfolios, full stop. Are they diversifying away from the dollar, or are they just adding that buffer into their portfolio? It's a combination of a lot of different things. They have signaled to us in our survey work that we do with the central bank community, they're concerned about inflation. They're concerned about liquidity, and they're concerned about asset preservation. Gold plays that role. So they've been big buyers, and they continue to set records. Last year in 2022, we had an all-time record for the data that we saw coming from consumption of gold by the central banks in more than 50 years. And all the data we have on record, the largest year in terms of consumption for the gold market. And the first quarter, they have another 228 tons coming into their coffers, mainly China, Singapore, and Turkey. And what that's telling us is that there's a reserve currency portfolio universe that's actually saying gold needs to play a partner. And in the retail space, you see a lot of different interesting aspects playing out. Like in the case of China, they've been under COVID lockdown for several years, and they've just opened. And now you're getting these people who have been traditionally large consumers in the retail space, jewelry in particular, back out, living their lives again, a normal lifestyle. And actually, that's starting to play out, and you're starting to see those feet on the street, spending those dollars, those pent-up dollars, are onshore in China, obviously the renminbi, but spending that savings in the form of jewelry. That corresponded in the first quarter with the Chinese New Year, an auspicious time to be buying. Now, the flip side is that with all the concerns that you have around the potential for continual rate hikes and the confusion and the challenges around managing a portfolio going into these rate hike environments, that headwind has kept investment on the sideline. Okay, mainly in the case of ETFs, but also in the case of institutional consumption. As well, what you can see is the higher price performance that you've had. You have India, which is a market that is a very price sensitive market, stepping back from the retail buying and actually selling and lowering the amount of demand, because they're very price sensitive. And when prices reach high levels, they tend to back away from the consumption. So you're getting these kind of two different categories of those consuming and those stepping back or holding off, while the factors that play into their decision around gold kind of playing out. And so as a consequence, net, we had a good quarter, a strong quarter, but not a large percentage increase in the overall quarter-on-quarter demand that took place for first quarter 2023. Hopefully that makes some sense.
Yeah, super interesting. So let's see if we can tackle those one at a time real briefly. So central banks are buying more gold. You said they bought a record amount in 2022, strong here first quarter of 2023. That I can sort of understand, right? The world's just becoming a less certain place, and people are falling back on, trusted assets, gold being one of them. Okay, totally makes sense. So I would expect until things quiet down more, that trend is probably going to continue for the foreseeable future. China, I'm assuming gold demand in China went down because of the lockdowns. And so,
Absolutely.
okay, so it did. So now we're seeing a rebound because they're opening it. Do you expect this to be like a sugar rush? Would you expect future quarters here to see a diminishing of demand as that opening effect, gets in the rearview mirror? Or are there potential developments there like, the world seems to be at risk of going into a global recession, so consumers are probably going to buy more anyways. But I know in China specifically, they've had a lot of issues with their real estate market recently, which was a massive store of wealth for people, right? They would buy these buildings in a ghost city somewhere. But now with the troubles in the real estate market, I'm wondering, I don't know, but I'm wondering, is capital beginning to say, wow, I'm not so confident in real estate anymore, so let me buy some gold to make up the difference? Is that a material factor there?
Well, I think that it's a great question to tackle. I think in the case of China, this first quarter, we were excited to see that the numbers confirmed our hypothesis that we were going to see a pop in the demand. The demand definitely tapered off quite substantially, particularly in the retail side of things. And our expectation is that getting back to a normal type of lifestyle in China will bring us back in line with some of the tradition, like some of the levels that we've seen in terms of retail consumption. And to your point around the risks and how the community on shore is actually tackling the issue of risk and assets, what's actually quite interesting to talk to about in China is the fact that over the last several years, now some of this has been kind of hindered also by the COVID lockdown and COVID in general, but what we've actually seen is an increased level of commercial bank and fund management company and products that are coming from these different institutions coming online and actually giving people investment solutions. Now, you can buy gold in jewelry form, you can buy gold in different types of accounts, and actually through the exchange, the Shanghai Gold Exchanges. But ultimately, we're starting to see an increased level of activity, albeit small for now, in the financial markets. So increased levels of funds, allocations to gold in these funds, and some uptake there. So we expect that what will play out in the case of China will be this ongoing demand in terms of consumption on the jewelry side. Have we kind of seen a big pop in first quarter? Will it slow a bit over the course of the year? There's a chance of that. But what we will ultimately see over time is an increased level of more ways of people buying gold and actually diversifying not only from jewelry, but also into the financial instruments. So I think that that's going to grow over time. And I think it's going to be a little bit more of a diverse universe of things that they'll be looking to buy.
Okay. And on the ETF side, just dig in a little bit more about why they're pulling back a little bit right now. Because you would think with inflation, now being headline news for over a year, gold being one of the few assets that held its own in 2020, you would think that perhaps you can make the argument that more people would be wanting to pile into gold as a result. And of course, the price has done pretty well, and Americans love to chase price, right? Why are we seeing a more conservative stance on the ETFs right now?
I think it's really an issue of timing. So we often talk about the behaviors that drive demand, tactically and strategically. And one of the big factors that we talk to tactically around investment demand is the opportunity cost. When rates are moving, when assets are actually in motion, what tends to be likely to play out with gold investment is that it's used, number one, as the source of liquidity. So we did see that. So it's an asset that holds its value, and people say, I'm going to liquidate a bit of my gold holdings because I know I can do that without price pressure. I'm going to redeploy and rebalance my portfolio. And that is what we've been living through since probably the tail end of summer 2022, which is rates on the move, Fed raising rates, and actual opportunity cost being front of mind for most investors. And they're looking to see exactly when and how to allocate to the bond market, maybe down from equities, or where else they could be looking. More recently, I think they've been looking at money funds looking at cash and how they could put money funds to work. But,
Sorry to interrupt,
but in the
basically
case of
because
ETFs, they've been slow to move, but ultimately we're starting to see that pick up now.
okay, and would it be fair to say because of the extreme and swift rise in rates, at least in the near term, maybe gold suffers from that a little bit because people are saying, look, I've got some gold, but it's not paying me anything, where I can now get 5%, in a T-bill.
Sure. Yes, but what I qualify that with is that most people understand the benefits of having the long-term return profile. So they gravitate to a world of opportunity cost and look at where they could deploy their monies and rebalance their portfolios. But when you move into a world of settling down on the rate rising environment, actually moving into the world of potentially rate cuts and moving away from transitory inflation management, you start to see gold play that significant role again. And that's when we're starting to see people making estimates, guessing, so to speak, about when that's going to play out. So in the world of ETFs, it was lagging the market, but as things became more certain, we started to see the flows come into ETFs in terms of expectations around rate rise.
Okay.
And with that as well, let me just add this piece.
Sure.
The systemic issues that play out tend to see the flows go into ETFs as well. So when you have a banking failure like SVB or others, you start to see people saying, okay, risk protection, move to gold. So you have these moments of slow moving kind of transitory inflation management, the headwinds of rates, and then you ultimately have this world of risk, which basically pops in the overall ETF landscape. But as clarity comes into play, that's when you start to see the flows coming into ETFs.
Okay, and the data that's in this Q1 report I have is obviously from Q1. Presumably, you're seeing some of the advanced data coming in now that we're kind of midway through Q2 here. On the ETF side, are you seeing any notable pickup?
Absolutely. I think I have a chart that I can pull up for you. And what we have year to date in terms of the flows for gold is that we've actually swung from a negative landscape of about $1 billion out in the North American market to fund flows of 2.9 billion and through May 10th of this year. So what you've seen is a significant swing in the sentiment amongst US investors. Now, ETFs in Europe are still in negative territory, and they're probably 6 to 9 months behind us in terms of this rate hike and cycle process that we're going through. And ultimately, you're seeing the sentiment start to signal, hey, we're kind of getting to an end of this rate hike cycle. Let's start looking and getting this asset allocation into gold going, and the ETFs are starting to signal that. And that's what we see.
And I'm sure the bank failures that kind of started in middle of March, so kind of near the end of Q1, and obviously that spilled over into Q2, probably didn't hurt the situation in terms of people deciding to go risk off and get more into gold.
I think that the banking crisis is one of these moments where the systemic issue that plays out with that definitely puts fear into the heart of people, and they basically move to gold. It shows itself not only in the ETF landscape, but it also shows itself in actually the bar and coin buying that we see, which has actually been another strong point in the first quarter of this year, which is in the US market, kind of offset by Europe. Europe has had a negative flow in terms of the bar and coin demand, mainly in Germany. But in the US market, you actually have really, again, another one of these top quarters for us in terms of the bar coin demand. And then you talk to the retail dealers, they're pleasantly surprised by it, but it really is simple to understand. I've got a concern about my cash in a bank. I've got concerns around the financial system. Let's just take this moment and deploy the cash simply into physical bars and coins. And you can do that in so many ways now through so many different channels. It's really obvious to people when you step back and say, yeah, I'm worried about risk, then there's no reason to think that you wouldn't see that kind of trend in the market right now.
All right, and let me ask you this: so Americans, feel free to negate this adage if it's not correct, but what I've heard, especially when it comes to gold, is that Americans love to buy it when it's going up in price, right? Where there are other pockets around the world, Asia more specifically, where they tend to love it when it's going down in price because they feel like they're getting a better value. They have a lot more long-term confidence in it. And so, oh, it's going on sale, let me buy some more. The American behavior isn't limited to gold. It happens with meme stocks, cryptos, et cetera. It's just kind of how we do it to a certain extent. One, I'd love to know your sense as to whether that adage is actually true or not, but also gold is up near its all-time highs right now. From what you're telling me, it sounds like the increase you're seeing in buying, bars and coins by the retail American, that is still largely being driven right now by concerns and fears of instability. It's not yet it's sort of a mania stage, like we've seen at different points in times where the gold price has gone parabolic, where people are piling in because, oh my God, the price is going up and I want to get in before I'm priced out, right? We're not necessarily, I don't think we're seeing that yet, but you tell me.
Yeah, I think historically, looking back when we had large runs in the price and then basically big drop off in the prices of gold, I think that might have been more emotionally driven. That might have been more fear driven. I think what you're seeing today in the market for gold is actually a much more thorough analysis of the asset, a much more thorough understanding of how it plays into your portfolio, and stable, steady buying. So does the U.S. market, do investors in the U.S. chase the price? I really don't have anything to tell me that they're chasing the price and that's what's driving them right now on that. I think that what's driving them right now is that they see inflation. They see inflation leading to potential recession. I think they see risks in the financial markets and the financial system. And I think they see these ongoing questions around, even as we speak today, what does this all mean to me from a debt ceiling crisis? I mean, if we don't get through that moment, what's that going to mean to me as an individual? So are they chasing this price up? I don't think so. I think what they're doing is they're simply saying this asset makes sense even as we hit these levels. And that's why you continue to see these trends of people going into gold and the flows continuing to play out. I mean, in the first quarter of 2022, we had an incredibly large quarter for consumption. I think it was around 558 tons of gold that was bought in investments, and that included ETFs. But remember, that was leading into a geopolitical event with the Russian invasion of Ukraine. And now we're still seeing large numbers in terms of what we're seeing in first quarter, 274 tons. But it's coming on the basis of saying, hey, look, there's real sustained reasons for you to have an allocation to do. So I don't think that we're going to see this price chase, this euphoria that maybe we have seen in the past, and kind of turning that a little bit on its head. It's actually quite interesting because with all these different people and all these different sources of demand playing out, what you're seeing is that you're getting a much more stable price level at around 1900. Right? We're not dropping the substantial amount that maybe people would have expected when you start to peak and hit these high levels. So things are holding up and the flows continue. Will there be a slowdown in retail? It's possible, but ultimately you're still seeing people moving their monies into the gold asset.
All right. And you're reminding me of some questions I probably should have asked you right at the outset here, just to help folks understand the gold market itself. How big is the gold market?
Right now, the gold market is about a $14.5 trillion market worldwide. That's all forms of above ground stocks.
Okay. So that includes jewelry that people are wearing on their arms. It includes the bars that are sitting in central banks around the world. And then it includes whatever's in industry, and then the little bars and coins that are in people's home safes.
That's right.
Okay. All right. So 14 trillion of that, and I don't have the latest numbers. Maybe you do. How much is in investment, right? When we look at the world, collective portfolios around the world, like what percent does gold make up? My recollection from hearing past stats is it's a shockingly small percentage, but you might know.
I'm going to jump in because so many times, and this is why we love the work we do. So many times people want to look at just the ETF market and go, investments is small. And actually, that's just a small piece of a big investment landscape. The AUM for ETFs as of today is about a $228 billion market worldwide. Okay, that's every market that has ETFs. That includes all the markets in Europe, every product in Asia, etc. It's $228 billion. The investment landscape, bars and coins, including ETFs, is about a $3.3 trillion market.
Okay.
Okay, so we have a pretty substantial number when it comes to the investment in gold. That doesn't include the near $2.5 trillion that are in central banks. So I don't think it's so easy to say that the gold market is just really small from an investment perspective. I think it's actually pretty substantial.
So here's what I was going to try to validate with you, which you may be now invalidating, which is that gold is underowned in people's investment portfolios. And part of people who are pro gold oftentimes say, hey, when the world wakes up to the fact that it should own more gold, that's going to explode the gold price, because you're going to start having some percentage. It still might be a small percentage, but if a small percentage of the bond market wanders into gold, that's much larger than the numbers that you're mentioning here.
Right. So you're right. Now, what I would say is that the market is large. And look, there's a couple of reasons that I think people should understand how large this market is. And one of them, which I don't want to go down the rabbit hole just yet, but I do want to put a pin in the fact that when people tell me cryptocurrencies are replacing gold, I look at it in this light, and I simply say I've got a $14.5 trillion, near $15 trillion market, and that's a $2 trillion market. So this is different. This is real. This is substantial, and this is material. And when I look at the overall size of investment in gold, I think it's material. Now, to your point around, are portfolios appropriately allocating enough gold to their portfolios? Do we see a material level of that? We see that at the institutional level, about somewhere around 30 basis points in the total size of wallet that's eligible, about 30 basis points allocated to gold. And we believe that that is an under allocated percentage relative to the value you can get out of the portfolio holding gold. So when we do work with institutions, or we work with clients around what's appropriate, the range moves from that kind of average of 30 basis points to a much more substantial number, 2.5, 3, 5, 10%. These are the numbers that people start talking about when they make a decision to own gold. Some portfolio managers, for example, if it's a real asset portfolio, maybe even going as high as 25% in terms of their overall allocation. And we do a lot of work with the institutions to try and take them down this education path. They got a lot of preconceived ideas around gold. They worry about like, I don't buy commodities. And then when you start peeling back what the risk factors that they're trying to challenge themselves to address, and they start understanding how gold helps them with that, they get over the line pretty quickly. So we are under allocated at an institutional level as an asset. And I think that when you do get allocations, they start to come into line with those numbers that I've talked about. Call it 2 to 10% in terms on an average number of allocation.
Okay. Just because people don't think in basis points so naturally, when you say 30 basis points, you're basically talking about a third of 1%.
A third of 1%, correct.
Right. So again, just to sort of paint it, a very tiny, like almost insignificant fraction of portfolio allocations on average right now on the institutional side. And that's a big part of, I guess, what the World Gold Council does, is it talks to institutions like that and just says, hey, you make whatever decision you're going to make, but let's help you make an informed decision. And a lot of them, once they begin to realize that, oh, okay, maybe I was thinking about it the wrong way, they tend to generally increase their allocation.
That's right. That's why we produce our data. For example, the report that you've highlighted, our GDT report, our gold demand trends report, we've produced that for 30 years. And actually what that helps people understand is that the information in the data is organized in a way to help you move to the next step, which is to analyze factors that are actually playing out as potential, some things that will impact overall asset movements in general, and how those behaviors amongst the demand and those factors will come together and give you an expectation of the expected long-term return on gold. The case for gold's pretty straightforward. Long term, it provides returns. And we have the math to demonstrate that for investors. And on average, the return profile long term is about 4%. It has the right kind of diversification benefits. I talked about correlation and when you have it in bad markets and the good markets. You can see when you correlate gold to other assets and risk assets that it tracks equities, as an example, the S&P 500. It tracks the S&P up with wealth creation and it tracks up. And then when markets are selling off, it definitely correlates in a negative way. And then it is a liquid market, $150 billion worldwide on a daily basis. All that coming together gives you the right kind of portfolio impact that you would want to have when you talk about an asset diversification.
Right.
And that's when we get into the 2.5 to 3 to 5 to 10% allocations. People say, yeah, this makes a lot of sense. And they get over the fact that I don't buy commodities or I don't know how to fit it into, what I buy. They find a way to make it work because they realize this is the kind of potential asset that gives me that comfort during shocking markets.
Yeah, and I'm betting that 2022 is probably, one of your best proof points to all this.
Absolutely. It's been a great experience of 2022 to demonstrate to people, hey, look, you know what? You show me an asset class that really soared in 2022, particularly in the second half of the year. Most people in isolation would say, well, the gold market was probably off. And I'm like, that's fine. It was off. But guess what? It was stacked ranking third, maybe fourth if you include hedge funds at one point during the course of the year, behind broad-based commodities, oil, dollars, and gold. Everything else was in negative territory.
Yeah. All right. Well, look, I promised folks a deep dive into the gold market here, so we're going to keep on digging deeper here. I'm going to put up a chart here from the same report. It's the gold supply and demand table. And this shows people really how it all breaks down by the major components we talked about, jewelry, technology, et cetera, but it also breaks out their subcomponents when possible. And it's divided here, supply on top of the table, demand is this bottom half. Quick question about supply. So that, folks, this just sort of shows you the numbers, right? So we're currently producing, what is this? This is it's almost 1,200.
That's right.
See what, is that
1,174 tons for the first quarter of 2023.
Okay. So there's a line item here called recycled gold. And I'm just curious, where does that come from?
That actually is when gold, in whatever form it might be, whether it's in scrap from an iPhone that's been taken apart and you can take out the little components of gold that are in there, or in the form of jewelry that's no longer desired or wanted, or in the form of some, precious bar that might be designed to be taken and recycled. Ultimately, it's existing gold that gets taken back to a refiner and recast.
Okay.
And
but
actually
it
comes out of the ownership and into recycling, and it gets back into the world.
Okay. But is it mostly coming from like technology salvage? Is it mostly coming from the cash for gold?
I think the majority of it, and this was something we talked about a little bit earlier on in the program. In India, for example, jewelry becomes a large component of what becomes part of the recycled gold market. And I think that it's important to take that into consideration. Jewelry is a large component, but then increasingly we're starting to see technology feed into the supply side, and in terms of the recycling gold as well.
Okay.
What I would say is that's interesting
ahead.
is that it spikes. It spikes when you see the higher prices, in particular in a market like India. So you see less buying of jewelry, and you start to see more recycling of jewelry that's sitting in stock.
And presumably that's because people are taking it out because it's now worth more, and they're cashing it in either for money or to buy something, right?
Presumably, yes.
Okay, this is a great segue now to the demand side, and I just want to point out for folks here that this always blows my mind, but the jewelry is the big driver in this space. So I get people wear gold jewelry, but I in my mind would just think that would be secondary to all the investment reasons to own gold, but not at all. It is the big kahuna in the story here. Is that mostly, my assumption is it's less people just wanting gold to wear gold because it's pretty, and it's more these markets like India and China where it's been a time-tested asset, centuries, millennia, maybe of wealth preservation. And this is basically like almost personal banking, because in a lot of these areas too, until recently, or in a lot of cases, they still don't have access to banking. And so the way to store wealth is to buy gold, and you keep it safe by wearing it on your person. So I'm curious, is that true, or is it more just the
No,
luxury?
that is absolutely true. And actually, I've spent a number of years of my career in Asia, and actually, when you visit a place like China and you understand the auspicious nature of gold in the entire country, you start to have a much better appreciation for why the numbers are so substantial and why the demand, in particular China and India, and the jewelry demand there are so high and so constantly high at somewhere between 25 to 30% on quarter in terms of the jewelry demand and the retail demand. It's material. You're absolutely right. Is it just to look bling, so to speak? No, there's more to it. It's embedded in the history of these people's countries, and it's a wealth issue. It is a statement about wealth. It is a form of savings, and actually, it's a form of passing on the savings too to the family. Mm-hmm. So you can actually gift it, and you can actually have it as part of dowries or whatever the case may be. And I think that it's still a substantial number, and it continues to show that trend. And that's why when we talked about China, quote, coming online and the feet on the street, all of that has been suppressed when they had a zero COVID policy. They couldn't shop, they couldn't be out, couldn't be consuming like they have, and they always want to. So it's exciting to see it open. And we are good, happy to see that that this demand is coming back online as we expected it to.
Okay, so I mentioned that there's heightened risk of a global recession here. Is a recession good or not for gold jewelry? Right? Do people buy it more because they're worried about all the crisis that comes along potentially with a recession, or as you sort of said, you're seeing demand dip in India because the price has gotten to a certain height? Does it actually depress these people's ability to buy gold, and it's actually a net negative for jewelry demand?
Well, I think it's a complicated question to answer as it relates to jewelry. But stepping back, what we can say comfortably about gold in recession times is 5 of the last 7 recessions that we've had, gold has performed exceptionally well in those times. And so what you find as a risk asset, or I should say as an asset to preserve wealth, what you'll find is its performance is strong, ranging from 4 to 8% if you kind of ignore the really significant returns that you had the recessionary times in the early 70s. And I think the right way to respond to the question would be, if jewelry is how you are preserving your wealth, maybe you slow down on the consumption side as you experience recession, but ultimately you realize that it's going to perform like it would be if it sat in a coin or a bar or an ETF for you, and you're going to get that benefit from it. So I think that people are thinking similarly when they think about, why should I own it? And I think that's why the jewelry demand, it's more than just looking good and having a nice piece of jewelry around my neck. It's actually embedded in the kind of thinking around, how do I preserve wealth, and what's the right kind of asset to continue to, make that investment. And you're right to point out in India, and I pointed it out earlier as well, that the price point, it slows down consumption. It doesn't stop it, it slows it down. It leads to less demand and less consumption, but it doesn't stop it altogether. And I think that when prices move, you'll see it come back online.
Okay. And, gold is a globally traded commodity, which means it's sort of priced at the margin, right? It's whoever's willing to pay the most for it sets the price. And there may be things in a recession where some of these other factors dial up. Maybe investment demand starts setting the tune for it, right? You're nodding a little bit as I'm saying this. All right, let me just continue to dial down the list here. So on the technology side, it's it's a much smaller fraction. It's almost like a tenth of jewelry demand. So it's not a huge driver right now. What are the major uses of gold in technology?
I think it's electronics. I think we all have iPhones, we all have iPads, or whatever phone brand that you own. It's embedded in that technology. I think, though, one thing I will highlight is an increasing use of gold in the scientific side of testing and other aspects that are small, growing, but important. Pull up something on it. We had a piece that I think is quite good, but I think the point to make on technology is that it's a small component, but an interesting one to keep an eye on. Number one, it fits into the day-to-day applications of what we use in terms of our devices and the technology that we have on our desktops. But it's also an increasing component that's showing up in scientific testing and actually medical testing, and also testing that goes along with things like COVID. And it's actually surfaced in that regard. But it's still a very small component. So I'd say it's an interesting space to watch, but a space that's actually going to continue to be dwarfed by some of these other much more substantial consumption areas.
Got it. And as a percentage of gold demand, do you expect it to grow or shrink from here?
I'd say to you that it's probably going to be outpaced in terms of its percentage by investment and by central banks. That would be what I'd say. So I'd say it might continue to show signs of, troughing and growing, but I think ultimately, as a percentage, it's going to continue to likely be, particularly in the next couple of years, outpaced by investment.
Okay, great. Great segue to the remaining two big demand buckets. So investment under ETFs here, which is the it's I guess it's right up. It's actually varied a fair amount here. I'm looking at how skewed the Q1 2022 numbers were by the Russian invasion of Ukraine. But let me ask this: for ETFs, are you is that demand that's here in this table? Is that just physical demand for the ETFs? Because ETFs also hold lots of futures contracts and things like that. But I assume you're just tracking the actual physical purchases by the ETFs,
right? So our data set is, call it 90 products worldwide. And for us to feel comfortable and confident to report the number, it has to be backed by physical gold. So every product that we track and every number that's here is when it represents physical ownership sitting in a vault behind it. So your inverse and your levered or derivative based are not here. These are physical owned ETFs, physical gold held by the ETF itself. So call it 94 products.
Okay.
Is that clear?
Yep. And so let me just raise a topic here. And by the way, Joe, I'm going to call an audible here. If you've got time, I'd love to be able to go a little bit long with you here, because there are a number of other questions I have yet to ask that I know folks are going to be really interested in. And if we're giving them the deep dive, I don't want folks to feel like we cut them short on a couple of these key things.
No problem.
I appreciate that. I've heard stats that when you sort of compare the size of the paper to physical investment market, the paper is 100 times or more, as large as what's underlined by actual physical gold in the investment sector. And there's, let's say, a lot of debate on the wisdom of the potential of having a system that lets a paper price heavily influence spot price. And there's associated concerns with this about rehypothecation or counterparty risk, where if you're, are there situations in which your futures contract just may not settle because the contract gets broken for whatever reason, rehypothecation or otherwise. Do you have any comments about how the current paper system is set up in regards to the physical aspects of the investment category we're talking about here?
Yeah, there are a number of different things that we could talk about, and I'm going to start by kind of level setting on the products that we track and the products that we understand. So we go through each product and we look at the detail around what they do and how they own it. So the ETFs, as an example, do physically own the gold. They own it in what we would say is an allocated mechanism. And that allocated mechanism means that it stays in that account on their behalf, full stop. And they need to have that gold there to maintain the tracking that they have of the price itself. The asset can't be rehypothecated. It is allocated and legally held on their behalf, and it must match that outstanding issuance of the ETF, or else the product won't work. Now, that's how the products work. So for each ETF that is physically backed by gold, the gold is there, and the gold is allocated, and the gold is not physically rehypothecated in any way, or double dipped, or used in any other mechanism. Anyone that tries to make that case doesn't understand the mechanisms of how the ETF work.
Okay. And are you okay if I mention the name of one or two physical backed ETFs just
Sure.
as an example? So like Sprott's Fizz ETF,
Yep.
presumably is fully backed in that manner.
Correct.
Okay.
That's correct.
Great.
And in the case of other products in the US, you've got GLD, IAU, the two largest products in the US market. They're physically backed by gold. That gold is allocated. And using a term that's not gold market oriented and might be more familiar to the audience, that means the gold's segregated and held without question on behalf of the fund itself.
Okay, let me just dig here for a second, because I may have had a misunderstanding then. I was under the understanding that GLD holds at least some of its gold in the form of futures contracts. Is that not true?
Not at all. All the gold held by GLD, all the gold held by IAU, and all the gold held in this number is large bar, 400-ounce bars.
Yeah, the COMEX deliverable.
The big LBMA good delivery bar, the one you
LBMA.
see in all the pictures.
Yeah.
The one that makes you really excited, and when you hold it, you're embarrassed because it's so heavy. It's really
Okay, great. So then is it fair to say then some of the concerns that have been out there on the internet about, don't hold an ETF that because they have these futures contracts that you may introduce counterparty risk. It sounds like what you're saying is that's not the case, at least for the major reputable ones that are out there.
Absolutely. Absolutely. Number one, do your homework. Number two, the reputable products from the major players to be trusted, no problems. And number three, don't believe what you read on the internet about this stuff or you hear from these people. It's not correct. And actually, what's very interesting is that we don't necessarily advocate an ETF over physical. There are benefits to owning both. And actually, that's what people need to understand. If you're more comfortable owning small bars or coins or large bars for that matter, then that's fantastic. Our information on our website can help you understand that. You can work with firms like GBI who can help you understand that, and you can go about owning gold that way. If you want to own an ETF, check out our website. The information is there. You can get real good information on how the products work, why you should feel comfortable with it, and it'll give you the price performance through buying an equity in the market. That's what the key thing is here. It's easier access if you don't want to go through the physical ownership mechanism.
Okay, great. So for folks that are interested in potentially owning, getting precious metal exposures in their portfolio through an ETF, on your website, you guys maintain a list there of ETF providers that you guys have said, hey, we've looked into them. They're doing this in a
That's right.
way.
We produce a monthly report on the ETF flow so people have an understanding of it, because we think it's important for people to see how this little piece of the gold market does a good job of describing how the gold market works and how people are behaving. But we have every one of those products. It's in our website. You can go and see what each one of them have and all those numbers add up to what you see in our gold demand report every quarter. You'll see the numbers every quarter.
Great.
And so you can see it.
You're doing exactly what you said your mission was. You're educating, you're improving access, and you're providing trust with all this information. That's great. All right. Well, look, let's move to the last category here, which is the central banks, which seems to fluctuate, a fair amount from quarter to quarter, but is still pretty material at this point. You mentioned you saw record central bank buying in 2022. Seems like that momentum is still continuing through here. I think I asked you earlier if you expected to continue. It sounds like you did. Anything else to say about the central banking component here? Because, it's so interesting. Everybody still remembers, I think it was Bernanke, calling gold the barbarous relic, and I'm not sure why we still own it, but central banks around the world continue adding to their stocks.
They do. And actually, there's three things that I'd say that people should have a very good appreciation for. Number one, the reserve portfolios of these central banks that continue, and it's about 20, 25 of them that have been active. Some have been buying and selling, but net flows have been positive. And these reserve portfolios have the same kind of concern. The people that manage these reserve portfolios have the same kind of concerns and questions that others have around their money and making sure that they're protecting against inflationary issues and against shocks to their portfolio, and ultimately the ability to be able to liquidate an asset when you need it. And that's what central banks are continuing to have top of mind in terms of their motivating factors. The second thing I'd say is that we produce an annual survey of central banks that gets real granular around their mindset and their thinking and their future ideas of what they're going to do, particularly in the gold space. Now, we've had numbers that have supported ongoing holding of gold and actually growing of gold. But what I'd say is I don't want to use those numbers because we're right on the cusp in June of releasing that next phase of that survey. Mm-hmm. And I would say that people should check it out because that'll give you a real good view on exactly what's going on in the minds of central banks. And then the last thing that I'd say about central banks that's really important for people to have an appreciation for is we're probably in one of the most aggressive sanctions programs with a G20 country. And this is really substantial in terms of the financial impact it's having on the globe. And I think that there must be, in the minds of these central bankers, some thinking that if I have gold in my portfolio and I'm at risk of having sanctions right against me, I'm going to have some sort of benefit from having it.
Yeah.
So I think it's important for people just to accept that. And I'm not saying this is a de-dollarization. I'm not saying that people are leaving the dollar. What I am saying is that it's important for people to have an appreciation for the fact that if there's pressure on the dollar and diversification of these assets is actually on the minds of these reserve bankers, that it's worth making note of.
Right. It's just a prudent insurance policy that you can expect these guys to make. All right. Well, look, we don't have I'm trying to be sensitive to how far over we go here. This was a multi-part question. I'm going to collapse just into one, which is, macro events obviously can influence demand for gold. I'm going to list a couple and just ask you to either, pick the one or two out of the list that you think are kind of the most weighty, or if I've missed the most weighty ones, just add them to the list, right? But there's central bank policy, in money printing, kind of currency debasement, right? And again, we could have had this whole discussion prior to the trillions that were released during the pandemic. There's the impact of what happens with the dollar. There's related to central bank policy. There's the increase that we've had in interest rates and inflation, and whether interest rates are real or not. And actually right now in the US, for the first time, at least using the headline CPI number, we actually have real interest rates for the first time in a long time. There's recession, which we've talked a lot about already. There's just plain old crisis, right? Like financial crisis, like something breaking, right? We're seeing failures in the banking system. We've got the debt ceiling woes that are going on. There might be some other grenade lurking landmine that we haven't seen go off yet. And then there's geopolitics, right? And we've seen the outbreak of war in Russia, a lot of saber rattling over Taiwan. Who knows what could happen next? Which of those do you think is sort of the most in control right now in terms of influencing the price of gold? Or is there something even bigger that I didn't mention in that list?
So I think that right now, the rates discussion, I think the trajectory of rates, the impact of rate hikes to potential rate cuts is probably the factor that's having the most significance on the price of gold, in particular in the U.S. I think it's created headwinds.
And sorry to interrupt, but you're talking basically the pivot, the big gamble that's being made right now, whether the bank
correct
Powell's going to pivot or not this year. Yeah,
correct. I think that that's having the most significant impact right now on the gold price. But I think the other factor that I'd put would be these risks that pop up, and I think that the risks that continue to pop up, whether it's cracks in the banks, the debt ceiling issue that you're talking about, the undercurrent of that is credit. The extension of credit, the ability for people to feel comfortable and confident around an ability to continue to source credit. And I ultimately think that that's a factor that's probably going to play out more into the summer months and into the second half of the year, that could actually show strength and tailwinds to ultimately the gravitation of money to gold as a safe haven asset. That's what I think is bubbling and not necessarily kind of being talked about in a very comprehensive way, that how that extension of credit could play out over the course of the next 6 to 12 months and what it could mean to people and their ability to save, their ability to spend, and their ability to run their lives. And I think that rates for now and that credit extension over the course of the next 12 months.
Okay. And obviously the trajectory on the credit side that we're seeing right now is that it is continuing to tighten, right? We're seeing banks tightening their lending standards. We just had the SLUS report that was very widely anticipated that came out and confirmed that. Jerome Powell's talked about that at most of his recent press conferences, that these tightening of lending standards are acting as additional rate hikes beyond what the Federal Reserve itself is already doing.
That's correct.
Okay. All right. I'm not going to ask you to make a price prediction, but I will say that there are a number of analysts out there, and actually I've had a number on this program quite recently. I've had a couple of independently, I've had a number of technical analysts on this program who independently brought up the gold price in the conversation to say that technically it looks really well poised here, but a lot of other people make a lot of the same fundamental cases that you've been making in this conversation. But the technical analysts are saying, yeah, if we actually break out, from here, which technically there's a setup in place that looks like it could lead to a breakout. They're coming up with price predictions of like, $2,500 an ounce within the next year or so. Not going to ask you to pick a price, but can you just sort of comment on that enthusiasm that seems to be growing amongst at least some segment of analysts?
And I think this will be a nice way for me to balance out the earlier comment around the World Gold Council, the role we play, and we're telling everybody to own gold. I think, frankly speaking, I think that we are at a range bound level that's higher than we've seen in the past, but we're going to still see a choppy gold price for the foreseeable future. As people look and deal with all these different factors and how they need to manage their money and how they actually decide to use gold in each one of those moments. So I think there's going to be choppiness to the gold price on the shorter term, but once we start to see things settling in, clarity around those rate hikes leading to rate cuts, leading to the potential recession, how this extension of credit or the contraction of credit extension plays out, that's when you're going to start to see a slow, steady rise in the gold price. So I think that this is still some choppiness to come, but I ultimately think that that'll play out over the course of the summer and into the fall, and then into the fall, into the end of the year is when we expect to see the gold price continuing to have factors that will drive it in the direction of up.
Okay. Gosh, I'm gonna unfairly ask you for a short answer to this question because I'm sure we could have talked about it for this entire conversation. Could we see a gold-backed currency introduced in the next decade? There's a lot of chatter about the de-dollarization narrative about BRICS countries that are going to get together and release their own competitor to the dollar, and it's going to be a commodities backed currency that's priced in gold grams. Is there much to that right now? Do you think that that's possible, probable, likely?
So is it possible? Yes. Is
No,
it
anything's
possible?
possible. So,
Is
yeah.
is it probable? There's been talk of this for some time. I think the audience needs to understand a few things about technology, and actually, I think it's important to give some clarity. Just tokenizing gold isn't creating anything new, and I think that that's an important thing for people to understand. I think what people need to appreciate is that the technology that's being used right now, the digital ledger technology, that's a technology that can actually be used in a number of different ways. You could get to a point, and actually, we're working under the auspice of the title named Gold 247, where we're looking to track and trace gold. We're looking at digital ledger technology to help us to do that. We're looking at how that leads to the next phase of, can you use technology to make it easier for people to access gold. It's easier for banks to trade in gold, and there'd be more transparency around gold. Now, that's not necessarily rolling out a digital gold currency or a currency backed by gold. What it is actually using technology to advance the gold market to make it more efficient. Okay, so I think that's likely to play out, in my mind, much quicker than the potential for a gold-backed digital currency to come out, which could potentially be out there to challenge the dollar. Is it possible? Like I said, yeah. Is it probable? I don't know. And I don't know if we have any evidence that it's being worked on. Lots of people are working on digital currencies. Lots of central banks are working on digital currencies, and a lot of experiments going on. But will one come out and be backed by gold? Maybe. I think that we like the idea of using the technology to help advance the gold market itself, away from being hard to understand and not very transparent, and actually bring all of that out and use the technology to improve efficiency.
Okay. I should probably skip this question, but I'm going to ask it anyway. So let's say gold gets remonetized, somewhere in there. What would that do to its price?
Help me understand what you mean by remonetized.
Like it becomes part of a gold-backed currency or something like that. It's actually being used as
so if gold were to be
sovereign
if gold
currency.
were to be necessary to support and back a currency, then I think it would ultimately it would actually drive demand up if you assume that currency is going to be adopted, right? I mean, it'd have to be. It would have to ultimately put pressure to the upside on the gold price.
Okay.
Right? It's a reintroduction of gold standard in effect, right?
Yeah, like I said, it's totally unfair to ask you to talk about this in such short time frame at the end of this long discussion. But okay, great. The last question, second to last question, and then we'll wrap things up. I'd be shot if I just didn't ask you to opine for a moment on silver. We've been talking about gold the entire conversation here. Do you have any particular thoughts on silver to share?
It's hard for me, Adam, and I in terms of silver, I think I think the demand for silver is what I think I'd be comfortable sharing would be that the demand for silver is mainly industrial versus what we could see in terms of the differences between gold, where you have industry, investment, consumption, etc. I think there's been an increased interest in holding silver in addition to gold. But I think in terms of the behavior, I think the price and the long-term behavior of silver is driven mainly by the technical, or I should say the industrial demand for gold or for silver. It's driven by the industrial consumption.
Yeah, and it's definitely more volatile on the day you and I are recording this discussion. Silver's down 5%. So you have to have a cast iron stomach to be invested in it.
I kind of feel more comfortable if you didn't necessarily raise it, because it's not something that I analyze. And I know a lot of people look at the gold silver ratio, but it's nothing that we bank on. I think that's kind of a trader's perspective, and what we tend to look to is fundamental analysis of the gold market itself. And I just don't have that much detail on the silver market.
Totally fair point. Like I said, some of these last questions are kind of unfair to squeeze in here. Last one is, I don't presume you necessarily have a recommended way that the average investor should gain exposure to precious metals, but I'm guessing that you have sort of counsel on how to think about it.
Yes.
Okay.
Absolutely. So there are a lot of different ways for people to express their investment desire in precious metals. We would recommend to, number one, do your homework, but number two, don't rule any of them out until you understand the components, costs, and practical factors that go into each one of them. Physical bars and coins, exchange traded products, or funds that offer access to gold, futures contracts, and even if you're interested in owning equities but like the performance of the metal and you think that it's going to impact your equity portfolio, look at mining stocks. We've got a lot of information, in particular on making the right decision on the retail side. Our retail gold investment guidance under invest.gold is a great place for people to do their homework, talk to firms about the price discovery, talk to firms about how to go about storing gold, the costs that come along with it. Firms like GBI are very good examples of firms that'll walk you through the whole process of owning gold. So lots of different ways to express your interests and lots of resources available for you to make sure you can feel good and trusted about your gold purchase.
All right. Well, look, Joe, thank you for giving us so much time and so much of your kind of calm hand on the tiller expertise and explaining, and in certain cases, demystifying this gold market for our audience here. For folks that are interested in learning more about the World Gold Council and its efforts and benefiting from the resources that you provide there, where should they go?
They should go to gold.org. It's our website. Within there, you'll find Gold Hub, which is our investment focused site, and also a subfolder that's focused on retail investment as well. So you can get everything you need about us, the asset, and how to own it right in our website.
All right, perfect. That's a great URL. When we edit this, Joe, we'll put it up on the screen so folks know exactly where to go. Real quick, and just wrapping up here, I want to mention just a couple of free resources for folks. One, if it's okay with you, Joe, I will make this report that you and I have been talking about in this interview available for folks at wealthion.com/WGC. So you can download that report for free and see all the charts and detail that Joe and I were talking about, plus a lot more detail, obviously, in that report. Joe talked about kind of this progression, sort of understanding the different ways to own gold and whatnot. You should definitely go avail yourself of the resources that are there on gold.org. Just want to let folks know that Wealthion has its own sort of primer for the person who's trying to just sort of wrap their brain around what are the different ways to own gold and when it makes sense to consider one versus the other, both on how to buy it and how to store it. And so if you want to get your hands on that, just go to wealthion.com/how-to-buy. That's totally free. Last, there are lots of places, to go and potentially buy bullion. If you're interested in buying physical bullion, Joe mentioned a company a couple of times called GBI that actually stands for a company called Gold Bullion International. They actually own the Hard Assets Alliance, which you may have heard me talk about on this program before. It's the Hard Assets Alliance, the actual business that you buy and store gold bullion through. If you want to learn more about the Hard Assets Alliance, just go to wealthion.com/HAA. All right. Well, Joe, look, this has been wonderful. One last thing just to note, a lot of people want some hand-holding and trying to figure out in terms of, okay, given my personal situation, what are the best ways for me to own gold, and what's a sensible, percentage of my portfolio to dedicate to this, and how should I build that exposure over time? Most of those questions are best answered with the partnership and expert guidance of a professional financial advisor who is very aware and respectful of the role that gold plays in a portfolio. And I will say, a lot of them don't fit that mold, in the sense that a lot of professional financial advisors will sometimes discourage their clients from owning gold because the advisor doesn't make any money off of that. And so I think that's a really important filter that you want to use when trying to find a financial advisor, which is, hey, do they respect the role that precious metals plays in your portfolio? And are they willing to counsel you to build some exposure, even if they're not making direct money off of it, right? They should want to, because it's putting you on a more secure footing from your overall personal financial situation, which is going to make you a better client for them in the long run anyways. So if you're having trouble finding an advisor who can give you that type of counsel, consider scheduling a free consultation with one of the ones that Wealthion advises. Just go to wealthion.com, fill out the short form there to schedule a free consultation. It doesn't cost you anything. There's no commitment to work with these guys. It's just a free public service they offer. Joe, again, thanks so much for coming on here. Number of questions we didn't get to. Hopefully we can have you come back on the program again in another quarter or two. Give us an update on the latest trends that you're seeing in the gold market, and we can dig into some of these other questions we didn't get to.
It sounds great. It was great to be here today. Thanks very much, Adam.
Real pleasure, Joe. Thanks so much.